Hey everybody, this is Paul doing a dividend video. Today's date is February 28th. The market is currently open, as you can see. So as I'll be hitting refresh, you'll see numbers changing on the screen. So where are we at? What is going on? Alrighty, so February has been defined by two things that are very different from January, obviously, and that is bond yields and also the dollar. As you can see, January the dollar basically touched something like 101, went down. Japanese yen went down also. Everything was looking hunky dory. Everything was great because the market thought the Fed was going to cut this year. And that is a very different reality from where we're at now. But oddly enough, the market has kind of ignored the bond market, which is very interesting. Now, it has obviously moved from 41.70 in the month of February down to where it's at now, 39.85. And why is it at that level? Why that specific level? What's specifically going on there? And that has to do with our friend the lines. So, very simple as to what's going on is this is a very technically driven market. It's lots of computers talking to other computers. So basically, this is a chart that I literally copied from, or saved from yesterday. It's from Fidelity here, and the date is as of the 26th, so you can get the general idea. But as you can kind of see, so the 50 days in the little light line right here, and the 200 days in this line. You see how they crossed right here. They came back over here, and they're currently, it's very hard to see, but you can see they're currently crossed again. So that is a bullish signal. So what that tells technicians is this October was a retest of this, and then we went up from there, and then the 50 and the 200 crossed. Those are the type of technicals that you just can't ignore. So what does that mean? So as you can see, the 200 day is the orange line here. So the 200 is this is a good thing that this is actually in red because it effectively acts like a line in the sand. Now this moves every day because it tracks the last 200 days. You can see it's kind of trading flat and it's going to start to kind of go up. So the bear narrative is still saying top line is where we're going. You see this right here? Now bears are ignoring this technical stuff right here. They're saying that this is just, you can ignore this, don't worry about this, don't worry about this technical stuff. This is a bear market rally. Well, okay. I'm supposed to, this problem I have with bears is basically they tell me to follow the technicals on this line, but they tell me to ignore the technicals on this line. And there are other people on here, Northern Trader, the one that I had on here before. The, where's he at right here? This guy right here, Northern Trader. He's on Twitter. You can hear him all the time. Very vocal on Twitter. But he posts very, very detailed explanations about the technicals. And I very much encourage people to go check that out because it'll really explain why we're moving in this range. And kind of what's going on. So, where are we going? What's going on kind of thing. So consumer CPI, consumer price index, came in hot again. It's weird to tell people this who live in New York because they don't understand because they all live in apartments. But there's a reason why you're ignoring shelter. And the simple thing is I'm not sure how many more times I need to link this, but landlords are completely losing their ability to hike prices. It turns out that when you jack up prices this high, all the investors come in and say, "Hey, we want to take advantage of that too." So they build a bunch of multifamily things. Well, the problem is all those projects are now completed. So now there's a flood of multifamily projects. And I can kind of, I do DoorDash and whatever. I kind of drive around. You can actually kind of see these brand new projects that came online And from what everybody's kind of telling me when I was kind of posting like different things about, what's going on, and they're like, well, they're offering like the first month's rent free completely. If you're living in a place that hiked up your rates like this, jacked up your stuff, and they're still refusing to negotiate your price, you're gonna move. And it doesn't take a genius to kind of walk around. You can kind of see the U-Haul vehicles in front of apartment complexes. Those people are moving into those new units. They're shopping online. They're not stupid. They see this. This is what they see. So the shelter component is going to come down. It takes forever, and it's based on a survey. It is the stupidest thing that we have in this country right now. If this ends up causing this part right here specifically ends up causing the Fed to hike us into a recession, I think Democrats and Republicans in all the states need to come together and force the BLS or whatever to come up with a better system. There needs to be a centralized system where all rents are reported. We shouldn't have to use stuff like Redfin or surveys. Like our entire U.S. economy depends on this stupidity right here, and it's so silly. I hate it. So, because if you look at core services X shelter, it's this down here. We're all the way down here. If you include energy and food, where you add maybe like another 2%, but it's so horribly annoying. So we have other things that are going on also. You can kind of see just the different reports are coming in that are coming in hot. You can look at previous Januaries, previous Februarys, previous Marches, that kind of thing. You're going to see that they're going to come in hot. Now this chart doesn't go all the way back, but it's because everybody gets their tax return. I filed on the 15th, got mine by the 23rd. The IRS processed tax returns extremely fast this year. Could be the 80,000 new agents. I don't know. Whoever it was, they did their job. They did it very quickly. So expect February consumer consumption to come in hot. It's just going to come in hot again. Um, Now, what does that mean? How does the market interpret that versus what the actual reality on the ground is? People are going to spend their tax returns. And it seems like there's economists in the market that have a problem with this. I'm not sure what they want people to do. Do they want to put them in savings? Um, I think it's so confusing what economists want people to do. Do they want the president to get on TV and tell everybody to stop spending money? Because I think that's kind of what they want. Like, hey guys, stop spending money for 2 weeks. The Federal Reserve is going to cause a recession if you keep doing that. So we keep getting leading economic indicators that are showing just a complete disaster. It's pretty obvious where we're going. Now I'm going to explain why we're going there and what exactly is happening. So this right here is going to be the big word of 2023, 2024. So the way that the Federal Reserve is interpreting all of this data is that the consumer's hot and we need to keep rates at these levels. These levels right here, you can see, for longer. What does that mean and how does that affect things? Well, the way that it affects things is this right here. And I'm going to link this in the little comment thing for the YouTube video, but this is corporate debt maturities through 2026. What are corporate debt maturities through 2026? What does that mean? That is the corporate bond market. Now, this is a screen that I have not showed on this channel in a very long time, and I need to remember how to even get to it. But the corporate bond market is right here. There it is. And I'll show you what this is. Whenever you buy like HYG, LQD, these different things that are going on, there used to be a cute little, or great little chart right here that kind of showed where the average yield is right now. But this is actually showing different countries and stuff. But so if I go down to say corporate, so this is a very, very, very different chart than what I used to show on my channel. So the last time I showed this chart, these were like 2% yields. This is double A, or this is A. This isn't even junk. This is the nice stuff. This is the good stuff. And if I go to corporate, you can kind of see where this is turning into a complete and utter disaster at right now. Right now, because of COVID, a lot of companies refinance their debt at very, very low rates because they were smart. because we had zero rates and people wanted safety. So they piled into corporate debt that was cheap. This chart right here can give you a general idea of just how much debt needs to be rolled over, because they only took it 2 years at a time, or they took it 5 years or something like that, but a lot of them took it 2 years. But here is where higher for longer turns into a complete and utter disaster, leading to a recession. And you can see if you're a triple B rated company, which is junk, and you want to get 2 years of debt, look at the difference between if you're an A rated company, which very few companies are. So if we go here, you can kind of see what debt's available, like who qualifies under this. So you can kind of see different utilities, Microsoft, for example, and that's it. Everybody else, this is why everybody loves Microsoft and that they carry a ridiculous valuation, is because they can finance, because they're a AAA rated company. So when even those companies have to refinance at 5% interest rates, you kind of get the general idea why they're doing layoffs. And then you also, so let's say, let's go into the Bs, and you kind of get a general idea of the riskiest companies in the country at the moment. And it's probably some companies you haven't heard of, but Reynolds American, GM's in here, and this is just page one. Out of these are all the corporate bond offerings right now, but you can see how many actual companies fall into this, and this is where higher for longer turns into an utter disaster. Because of U.S. companies, and these are the companies you never hear about, but these are the people that are employing people, even Marathon Oil's in here. If they have to roll over their debt at 6.5% on an interest rate that goes out to whatever, like this right here, these are the maturity dates. The maturity dates are all over the place because I don't have this sorted by any particular thing. I can sort it by what's closest or whatever, but you can kind of see, 7%, or I think that this is the coupon, sorry, but this is the coupon, 8% going out to 2040. Like this is the disaster. And it's a time bomb that's just ticking right now in the background. And it all comes down to this chart. If U.S. companies have to start refinancing their debt at these rates, now one thing that will happen is if rates do drop, these companies will refinance their debt just the same as any other American walking around here. Will people buy that debt? Or will they let them refinance that? That's a different story. So here's all the ETPs, Energy Transfer Partners. So these are these companies that everybody's telling you to buy right now, but they're sitting on top of time bombs worth of debt. So that's why everybody's telling you to move up in the credit structure. That's what every person that gets on TV that talks about that, that's what they're all talking about. So you can kind of get the general. Here's Micron. This is the semis. This is like 5% debt going out to 2033. So you can get the general idea of what the problem is with higher for longer. And then if you don't have free cash flow at all and you rely on the corporate debt market, that's why tech is zombie tech companies, all those ones in ARK, those are dead. Like there's no chance. So if the Federal Reserve goes through with higher for longer, it's a complete disaster. And then you can kind of see where it hits. You're like, well, why is Norwegian down? And you kind of go over here, earnings before market open. I'm sure it was a disaster, but also one problem is the 2-year was up earlier today. The 10-year was up earlier. And you can kind of see the bond market is pushing the market where to go. And eventually some people think this is going to get up to like 5.25 before they eventually just say, that's too much. That's enough. So if you're wondering why different companies are jumping around, this is why. And you can just go to the HYG and probably figure it out. HYG is made up of all of that trash that I just showed you. That's literally what this is. High yield corporate debt. It looks great when you look at it. It has a ridiculous yield. It has like a 5.32 yield. That's more than a CD is giving you right now. It's almost as much as an I bond is giving you. The dividend is ridiculous. Like the dividend is ridiculously high, but the problem is the lowest it traded during 2009, which was a credit crisis, was $67.80. The low was 61. We're sitting at 74. In October or in June, you want to get a general idea, we were sitting at 71, as low as 70. If you're looking for places where you're going to see cracks in the U.S. job market, this is where it's going to start. And then it's going to bleed over into these guys right here. LQD is investment grade, so this was anything above triple B. So you can kind of get a general idea of how this turns into a recession. And you can kind of see the low is 80. Now we're trading at 105. So this is what people are talking about when they're talking about moving up in the credit structure. And this is what the different investors who want to stay in bonds, they want to stay exposed to the market, this is what they're jumping into because you can get just a ridiculous, you can get a great yield. So that's kind of where we're at. And what happens, like how does this translate into a recession? Well, simple. If you have to refinance your debt at a higher rate, you're going to fire people to make up for that difference. You already saw it with Microsoft. You've already seen it with different places. And the refinance rates right now for like even AAA rated companies are ridiculously high. And that's because the corporate market is having to compete with the treasury market. And you can see it right here. So here's AAA rated debt right here. AAA, Microsoft, 9 months. A 9 month corporate is the average right there. U.S. Treasury at 9 months is at 5%. It doesn't take a genius. And then also you can kind of understand why the municipal market is getting hit. So if you go to my portfolio, you can see the AFB is down. This is why AFB is down. Is because you can pile into this, get a 5% yield. So the old adage, there is no alternative, there's definitely an alternative right now if you're looking for safety. If you're looking for straight up safety in the market and you want a quick return, 5%, there you go. Now, are you risking that the market runs another 6% a month or whatever? But yeah, but are you also risking that the market sells off 6% in a week because the Fed chair opens their mouth? Yeah. So that's how you kind of get a recession out of this whole situation. Is basically this: money piles into treasuries, money piles into basically these corporates that are going to pay a guaranteed rate. Pension funds, especially, will pile into this whole area of the market up here that you see. Anything pretty much above this line that you see right here, you will see pension funds without a doubt pile money into this stuff. Any of this up here, pretty much this whole screen is where pension funds are piling money into right now to get an almost guaranteed return. Pretty much guaranteed as long as the company don't go bankrupt, and even then, in bankruptcy, the bondholders typically get paid first. So that's kind of where we're at. That's how you get a recession, if nothing just breaks and we don't get a crash. Because we're not getting a crash from what I can see. It's just not breaking like that. The job market's still staying strong, which is shocking. The housing market, people waited until prices went down just a little, like the long end of the curve went down just a little, and they went and got mortgages and went out there immediately with their tax returns, put down payments, or they paid straight up cash. But this right here is how this turns into a long protracted recession. Is when companies like this have to finance 200 or 2, I don't even know what this is, 2 billion or 200 billion, whatever this is. I forgot. I got to think about it. But when you have to finance all of that, and it's definitely worth a read, so that you can get a general idea where all the debt's sitting, who's holding the debt, what sectors. Like you can kind of get a general idea what sectors are holding the most debt. So if you're going to invest and ride this out, you want to avoid sectors that have large amounts of debt that they have to hold, that they can't pass on. Utilities, they could pass on their debt to you and me. Healthcare, for example, they're holding a lot. But a lot of this is municipal too. So those are the different hospitals and whatever, the nonprofits, consumer products, that type of thing. So you're trying to avoid anything that's got debt that's maturing very soon that's going to turn into something bad. And especially if you see here, here's where it really hits into like a major disaster. See this triple B, this section down here? Sorry this whole video is focused on debt, but that's kind of what's going to cause a recession. Is you can see how the double B and the B debt, as you go further along, the more of it needs to be refinanced. And that's when it turns into a recession. So that's why you have a lot of economists saying 2024 is because that's when a lot of debt rolls over. So I think that's kind of where we're at right now. For this month, I'm right here. So you can kind of see. Now, this was with a very large amount of money deposited from my tax return. and I've also been depositing money from DoorDash. So this month actually would have been negative for me. But as we're going down, and I think we're going to stay above that 200 day, I keep adding to different positions, and you can kind of see the spreadsheet. I've been updating it on Twitter too. I post every time I do a major position change. I just literally added BST, 3 shares there. So you can kind of see I hit my target with BST. So now I'm going to try and get these targets to where I want them. And then as prices move around, I'm going to add around the different areas as dividends pay. I got dividends that are going to pay out on these two tonight. Almost almost $88 worth of dividends that's going to pay out tonight on these. And then I'm just going to move those targets. And then that's how I'm just doing the passive portfolio right now. So this is kind of where we're at. Like I said, I think my debt's low enough that I don't have to be too concerned about it. And I'm currently just building up stock mode, and hopefully we stay above that, stay above, the 200 day, and we don't break below. Because if we break below it, there's very little support below that. The next support is somewhere around 3,600, and we can get there if we get a very very hot CPI for February, which is entirely possible in March. The Fed could put another rate hike in 2023, which would be a disaster. They've already put three more that weren't even supposed to be there. They've put 75 more, or 75 basis points more of hikes, which takes us up to 5.5, 5.25. So we're gonna have to definitely see where that goes. So let me know what you think in the comments. Like I said, it looks like the recession is kind of far off right now, unless something breaks specifically. So that's kind of my feedback, and I kind of listed my reasons why. Is I think it's all going to be about the corporate debt market. As long as nothing breaks, higher for longer translates into the corporate debt market, which eventually leads to a recession as you get a large amount of layoffs. So let me know what you think, and then, like I said, I'll post that chart. Y'all have a very nice day. Thank you.